Usually when we look at a corporate earnings report, there's this almost universal expectation of boredom.
Oh, absolutely. Total snooze fest for most people.
Right. We brace ourselves for this dry, static spreadsheet. It feels like looking at the math of, a regional bank or something.
Yeah, you look at the revenue line, you drag your finger down to the profit line, and you just kind of nod.
Exactly. You accept the numbers as these disconnected facts living entirely in a PDF. But then you step out of the boardroom and into the world of freight and logistics, and suddenly that spreadsheet is completely alive.
It really is, because freight is, it's the ultimate leading economic indicator.
Which is exactly why we're here today. We aren't just looking at numbers. We are taking the Q1 2026 earnings call of Knight-Swift Transportation, that's ticker symbol KNX, one of the massive titans of North American freight, and we're using it as a magnifying glass.
Right. Our mission for this deep dive is to look right through that corporate document to see the invisible beating heart of the U.S. economy.
Because long before you buy a TV at a big box store or a contractor buys lumber to frame a house, those materials actually have to move.
Yeah, if you want to know what's happening in the macro economy, you don't look at consumer sentiment polls. You look at what is moving on the asphalt.
Okay, let's unpack this. Because if you've been paying any attention to the fight world, you know that for the last going on maybe 3.5 years, the trucking market has been trapped in this brutal down cycle.
Suffocating. Just absolute blood in the water.
Yeah, owner-operators going bankrupt, huge brokerages laying off thousands of people, trucks just sitting idle. But suddenly, looking at the tea leaves in this Q1 call, the tides are violently turning.
They really are. The environment they describe is shifting at an incredible velocity. And what makes this turning point so fascinating is the actual mechanics behind it.
Because normally a freight recovery means, what, people are just buying more stuff?
Exactly. Usually, it's driven by a massive boom in consumer demand. People get stimulus checks, interest rates drop, and everyone buys couches and fridges. Demand spikes, so we need more trucks.
But that is not the story here at all.
No, far from it.
I was looking everywhere for the demand spike in this report, and it's just not there. Retailers aren't ordering double the inventory.
What we are witnessing is a fascinating, almost unprecedented supply-side shock.
Okay, explain that.
So the turnaround isn't Americans buying more stuff. It's being driven by severe winter weather, an aggressive layer of government regulation, and honestly, a literal purge of bad actors from the highway.
A purge of bad actors? It sounds like an action movie.
It does, but it's playing out in way stations across the country right now.
Right. But before we get into the mechanics of that purge, we need to set the baseline for you listening. Because if you just casually glance at the Q1 headline numbers for Knight-Swift, your jaw kind of drops.
Yeah, and not in a good way. They are sobering figures for a company of this scale.
Let's lay them out. So consolidated revenue for the quarter was essentially flat year over year. Flat isn't great, but it's not a disaster.
Right. Flat is survivable.
But then you look at their adjusted earnings per share, their EPS, it plummeted. It fell from 28 cents in the same quarter the previous year all the way down to just 9 cents.
Yeah, that hurts.
And their operating income dropped by a staggering $37 million.
So if you're an algorithmic trading bot scanning headlines, you see a 67% drop in earnings per share, and you assume the down cycle is just accelerating into a free fall.
But the narrative from the executive team completely contradicts that. The underlying dynamics they outline reveal this massive coiled spring.
Exactly. They're treating Q1 as the absolute bottom of the trough, because in Q2, just one quarter later, they are projecting that same dismal 9-cent EPS to jump up to somewhere between 45 and 49 cents.
Which is wild. A sequential leap like that, quintupling their EPS in 90 days, is an incredibly aggressive projection.
It implies a fundamental rewiring of the market. And to understand how a massive network goes from a seemingly bleak Q1 to a roaring Q2, we have to look at what physically broke the supply chain in January.
Right. We have to rewind to the freeze that fractured the market. Because in January of 2026, this severe winter weather system hammered the Southeast and a few other key regions.
It's protracted too, just relentless.
Yeah. And Knight-Swift estimated that this specific weather event caused a $12 to $14 million net negative impact on their volume and operating costs. And they were dealing with sharply rising diesel prices at the exact same time.
The combination of frozen infrastructure and spiking fuel is just toxic to a network's efficiency.
I can imagine.
Think about the physical reality. When an interstate freezes over in the Southeast, A region that lacks the snow-clearing plows of the Midwest trucks literally cannot move. They pull over.
Right, they're just stuck.
But a driver can't just turn the truck off in sub-freezing temperatures, or the diesel fuel will literally gel up and ruin the engine.
Oh, wow, I didn't even think about that.
Yeah, so they idle, they sit parked on the side of I-95, burning highly expensive diesel, generating zero revenue, while their federally mandated hours of service clocks just tick away.
Okay, that paints a very vague picture of the cost side, but I really have to push back on the macro narrative here.
Let's go for it.
I'm looking at this weather excuse, and my immediate thought is, wait a minute, a bad winter storm happens literally every single year.
True.
We have freezes every January. Why did this specific storm in 2026 cause such acute, immediate tightness in the market? Why did spot rates elevate almost overnight when previous storms didn't do that?
That is the exact right question to ask, because it exposes the crux of the entire Q1 narrative. It wasn't the severity of the storm itself. It was the extreme fragility of the market that the storm collided with.
Let's explore that fragility, because I imagine a healthy freight market absorbs a few days of icy roads just fine.
A healthy market absorbs it seamlessly. But think of the trucking market over the last 3 years like a human immune system that has been slowly, relentlessly depleted. Freight rates have been so depressed for so long that thousands of smaller carriers, the mom and pop fleets with 5 or 10 trucks, they've been running on absolute financial fumes.
Just living load to load.
Exactly. They have exhausted their cash reserves. They haven't been doing preventative maintenance because they can't afford the parts. They've been deferring tire purchases, ignoring engine codes.
So the capacity of functional trucks was just quietly shrinking in the background.
Yes, and it was masked by the low volume of freight. The market had progressed to a point of extreme, invivable fragility. There was zero slack left in the system.
So the weather was just the match.
Precisely. When the January storm hit, these financially strained carriers simply snapped. Their poorly maintained trucks broke down in the extreme cold. Or they just couldn't recover financially.
They fell apart.
They fell apart. And critically, they abandoned their commitments to shippers. And suddenly, these major consumer brands are staring at frozen loading docks with no trucks showing up.
And that desperation is exactly where a behemoth like Knight-Swift steps in.
Yes.
Because 70% of their fleet is deployed in one-way, over-the-road service. They have the density and the maintenance infrastructure to step in and rescue shippers when the smaller fleets vanish.
But stepping in as the rescue carrier isn't just flipping a switch. When a shipper is desperate, they call Knight-Swift.
Yeah.
But pivoting a massive network to do a sudden rescue operation has huge initial friction.
How so?
You're deadheading trucks, meaning driving them empty hundreds of miles out of route to get to the stranded freight. You disrupt your own optimized flow.
Right.
That rescue mission commands a premium rate later, but the immediate friction costs contributed heavily to that painful Q1 financial picture.
And digging deeper into that Q1 pain, it wasn't just the weather dragging down the numbers. There were these incredibly specific one-off financial hits, like concrete blocks tied to their ankles.
Anomalous expenses that completely obscure the actual operational improvements.
Let's list these off because they highlight how complex running a multi-billion-dollar logistics company really is. First, they took an $18 million expense hit in their LTL segment, which stands for less than truckload.
Right.
And the crazy part is, this $18 million hit was from an adverse arbitration ruling on a claim stemming from an event all the way back in 2022.
Which perfectly illustrates the terrifying long tail of liability in commercial trucking.
It feels like a huge disconnect. If an incident happens in 2022, why is it tanking the operating income 4 years later? Don't they have insurance?
They do, but for a giant like Knight-Swift, they use high self-insured retention limits, meaning they might be responsible for paying the first $3 or $5 or even $10 million out of pocket before catastrophic reinsurance kicks in.
Oh, wow.
And the legal process in commercial trucking is notoriously protracted. You have the investigation, years of medical discovery, depositions, and finally arbitration.
And we've seen the rise of these nuclear verdicts recently.
Yes. So an event from 4 years ago suddenly matures, the ruling comes down, and that massive cash payout hits the ledger today.
Then, right on top of that $18 million, there was a $4 million expense in their truckload segment from an adverse tax reimbursement decision in Mexico, again, for prior tax years.
Another echo from the past.
Yeah. And they vaguely mentioned a deferred housing project write-down. But when you do the math, the 14 million weather hit, the 18 million legal arbitration, the 4 million Mexican tax issue, suddenly that $37 million drop in operating income makes perfect mathematical sense.
It almost entirely explains the gap. If you strip away those isolated events, the underlying operational health of the company was actually finding a floor.
And to accurately gauge that health, we have to explore the definitive metric of the freight industry, the operating ratio.
The OR.
Yeah, for anyone listening who isn't steeped in freight finance, I always like to explain operating ratio using a golf analogy. In golf, you want the lowest score possible. Operating ratio is exactly the same.
It's essentially your operating expenses expressed as a percentage of your revenue.
So if a company has an OR of 90%, they are spending 90 cents in operational costs just to generate $1 of revenue. They keep a dime before taxes.
It is the purest measure of operational efficiency.
So in Q1, Knight-Swift's consolidated adjusted operating ratio was 97%. It went up, which is bad, by 230 basis points compared to the previous year. They were spending 97 cents to make $1.
That is a razor-thin margin of error. It leaves almost zero buffer for macroeconomic shocks.
But what does a normalized market look like for them?
When the truckload market is healthy, a premier carrier like Knight-Swift typically operates with an OR in the mid-80s.
So they'd be spending maybe 84 or 85 cents to make $1.
Correct. The entire objective of this impending upcycle is the path to clawing back to that mid-80s benchmark. And the reason the management team expresses such aggressive confidence that they can get back there is because of a radical shift happening on the regulatory side.
Which naturally leads us to the most fascinating dynamic of this entire earnings call.
The regulatory purge.
Exactly. If the winter storm proved the market's capacity is deeply fragile, the glaring question is, why are there suddenly fewer trucks available? Where did everyone go?
To answer that, we look at the government's intervention on the highway.
Now, just as a quick aside for you listening, whenever a deep dive drifts into government regulation, it's very easy for the conversation to feel political. We want to be explicitly clear. We are maintaining absolute political neutrality here.
Yes.
We are not taking a stance on whether these regulations are ideologically good or bad or endorsing any administration. Our sole purpose is to impartially report Knight-Swift's perspective as detailed in the source material and to analyze the economic ripple effects.
A crucial distinction. We are just observing the mechanics of cause and effect.
Yeah.
And the primary cause to this capacity exodus right now is the coordinated effort by the FMCSA, the Federal Motor Carrier Safety Administration, and the broader DOT.
They are executing what Knight-Swift views as a massive, strictly enforced cleanup of the industry.
And to understand why a cleanup is necessary, we have to rewind to 2021. The pandemic boom. Spot rates spiked to the moon. It was a gold rush.
And like any gold rush, it attracted a flood of speculative prospectors.
Exactly. But Knight-Swift explicitly points out that this wasn't high-quality professional capacity. The influx included a staggering amount of inexperienced, non-compliant actors.
People who had no real background in the complex logistics of trucking.
Right, and no infrastructure to monitor safety compliance. And critically, a willingness to haul freight for wages that legally compliant carriers simply could not sustain.
They were artificially depressing the rates, and now this regulatory purge is aggressively pushing them out. The CEO actually stated that this market is benefiting the most from the removal of capacity.
Yes.
So who exactly is getting purged? Let's break down the specific targets, because the things going on out on the highway were honestly wild. Target number 1, invalid commercial driver's licenses and non-compliant truck driving schools.
This is a foundational issue. During the boom, there was a surge of improperly issued, specifically non-domiciled CDLs.
Wait, what does non-domiciled mean in this context?
It essentially means a driver getting a CDL in a state where they do not legally reside, often to exploit looser testing standards or bypass rigorous background checks in their home state.
Wow.
Yeah. Bad actors exploited that fragmentation to essentially purchase qualifications. You had drivers behind the wheel of 80,000-pound missiles who had never properly demonstrated the skill to maneuver them.
That's terrifying.
But the FMCSA has modernized their tracking. They are now aggressively preventing these invalid licenses from crossing state lines, revoking existing ones, and literally shutting down the CDL mills.
It's literally the equivalent of discovering a sketchy medical school in a strip mall, handing out surgical degrees without testing anyone, and finally the medical board swoops in and padlocks the doors.
That's an excellent analogy. It pulls thousands of unqualified people out of the labor pool immediately.
Which brings us to my absolute favorite term from this entire deep dive. Target number 2. Chameleon carriers.
It's a wonderfully evocative phrase.
It really is. I just picture an 18-wheeler rolling down the highway wearing a giant pair of Groucho Marx glasses and a fake mustache.
And that's not far off.
So here's the concept. A sketchy trucking company gets audited by the DOT. They're cited for egregious safety violations, bald tires, drivers running way over their hours, failed brakes. The DOT officially shuts them down.
Right.
But instead of leaving the industry, the owners simply go online, pay a small fee to create a brand new LLC, paint a new fake name on the side of the exact same trucks, and hit the road again the very next morning with a clean DOT number.
It is exactly like getting banned from a social media platform for terms of service violations and immediately creating a burner account from the same IP address to do the exact same thing.
That's wild, but they're cracking down on that now.
Yes. Historically, agencies were too fragmented to connect the dots quickly. But the DOT has modernized. They are tracking VIN numbers of the physical trucks, cross-referencing insurance policies, and linking the corporate officers. They are ensuring that when a bad actor is banned, they stay banned.
And target number 3 is the crackdown on self-certified training and English language proficiency.
Right.
The source notes highlight that many newly minted drivers were essentially self-certifying their training logs. They were grading their own homework.
Enforcing verifiable rules on training hours, combined with the federal requirement for English proficiency, which is vital for reading road signs, is acting as another massive filter.
And the cumulative effect of these targeted crackdowns is profound. For Knight-Swift, they already play by the rules. They always have.
Right. Their massive fixed cost structure already includes highly sophisticated driver academies and rigorous licensing checks. For the last 3 years, they've been bleeding margin competing against these chameleon carriers who didn't bear any of those safety costs.
Now that the federal government is forcing everyone to play by the exact same rules, the artificially cheap capacity is evaporating.
Which brings us to a wildly specific, absolutely fascinating debate highlighted in the call.
Oh, the hair versus urine drug testing debate.
Yes, this is a tremendous, almost tragic example of regulatory lag in Washington.
It honestly blew my mind. So obviously we universally agree we want the person driving a semi-truck next to our minivan to be sober. Knight-Swift has been using hair follicle testing on their drivers for over a decade.
Voluntarily paying extra out of pocket to administer it.
Right. And their internal data proves that testing a hair follicle catches 14 times more drug users than a standard urine analysis.
14 times. That is an astonishing variance. The science is straightforward. A urine test only detects substance use within the last 3 to 4 days. A hair follicle test retains a chemical record for up to 90 days.
But here is where the regulatory lag creates an insane loophole. The federal government operates a database called the FMCSA Clearinghouse to track failed drug tests. But currently, the clearinghouse only legally recognizes the minimum standard urine test.
Right.
So imagine a scenario. A driver applies at Knight-Swift. They failed a hair follicle test because of drug use a month ago. Knight-Swift rejects them. But legally, Knight-Swift is not allowed to report that failed hair test to the federal clearinghouse.
Because in the eyes of current federal regulations, the hair test essentially does not exist.
It's just not codified. So what's the ripple effect? That exact same driver who just definitively failed a drug test at a premier carrier walks across the street to a cheaper competitor.
A competitor who only pays for the federal minimum urine test.
Exactly. The driver passes it because they haven't used drugs in the last 72 hours, and boom! They are hired, handed the keys, and out on the highway.
This glaring loophole is why Knight-Swift and other mega carriers are aggressively lobbying for the implementation of something called Leela's Law.
Right. Congress passed statutory provisions years ago to allow hair testing results in the clearinghouse, but the Department of Health and Human Services hasn't finished writing the final rules to put it into practice.
Knight-Swift is heavily advocating for this to change, framing it as a non-negotiable safety imperative.
And think about the economics. Knight-Swift pays a premium to ensure safety, while competitors get a discount by doing the bare minimum and accepting the rejected drivers. If Leela's Law passes, it will wipe out tens of thousands of additional unsafe drivers overnight.
Which perfectly transitions us to the psychological and financial impact all of this is having on the broader market. We've established why trucks are disappearing, so who is left holding the bag?
The shippers, the people whose business relies on moving physical items. Which brings us to the shifting leverage. The shippers panic.
Using the word panic in a corporate context sounds hyperbolic, but when a Fortune 500 transportation manager realizes they can't secure a reliable truck, panic is exactly the appropriate word.
For 3 years, shippers dictated the terms. They demanded lower rates. But now, the balance of power has abruptly shifted back to the asset-based carriers like KnightSwift.
And we should clarify, an asset-based carrier simply means a company that actually owns the physical trucks and employs the drivers. This is the opposite of a freight broker, who owns 0 trucks and merely acts as a digital middleman.
So the asset-based carriers have the leverage. And here's where the math gets really interesting. Just 1 quarter ago, KnightSwift was targeting very modest low to mid single-digit rate increases in annual contract negotiations, maybe a 3 or 4% bump.
Right.
Fast forward to today, because of this sudden tightening of capacity, they have ripped up that playbook. They're now demanding high single to low double-digit percentage increases.
We are talking about 8, 10, maybe 12% rate hikes across the board. In an industry where operating margins are measured in single pennies per mile, a 10% structural rate increase is an absolute earthquake.
And the craziest part is the shippers are apparently paying it. They are capitulating because the CEO broke down 3 very specific market behaviors that prove shippers are losing their leverage. Behavior number 1, the surge in mini bids.
Right. So to understand a mini bid, you must understand contract freight. A massive shipper, say a national beverage company, agrees to pay a carrier $2.10 per mile to run from Atlanta to Dallas every Tuesday for a year.
Okay.
But right now, the incumbent carriers who aggressively won those bids 6 months ago are failing to service the freight. They either went bankrupt due to the purge, or they realize they lose money every time they turn the key at $2.10, so they just stop showing up.
They just ghost the shipper.
Exactly. When that incumbent carrier abandons the lane, the shipper is stranded. They are forced to issue a mini bid, a rapid short-term auction, just to get someone to cover that route for the next 3 months. A massive surge in mini bids is the ultimate red flag that foundational contracts are collapsing.
That paints a picture of total chaos. Okay, behavior number 2, the rise of turnback bids. Are carriers literally winning a contract and then handing it right back?
It is exactly a form of buyer's remorse, driven by the sheer velocity of the market. A carrier officially wins a formal Mad Proffer Plat, request for proposal from a shipper, but then immediately rejects the award before hauling a single load.
But why go through the massive effort of submitting a bid just to say no?
Because the spot market is moving faster than corporate procurement. The pricing a carrier proposed 60 days ago is already obsolete. By the time the shipper says, you won at $2.15 a mile, the carrier looks at the real-time spot market and realizes they can command $2.40 elsewhere.
Oh, wow.
So they reject the award, forcing the shipper back to the drawing board to inevitably offer more money.
The leverage has completely flipped. And behavior number 3, off-cycle bids have completely vanished.
Right. In a soft market, shippers become opportunistic. They issue off-cycle bids mid-year to test the waters and drive prices even lower. They fish for desperate carriers.
But those are gone now.
Entirely gone. Shippers are no longer trying to nickel and dime rates down. They are terrified of alienating their core carriers. They're scrambling just to lock in guaranteed capacity. KnightSwift mentioned shippers are even asking for guaranteed peak season support right now.
And peak season usually means the holiday rush at the end of the year. The fact that they're begging for Q4 guarantees in the spring shows how stressed they are. And all this panic leads to a broader shift. The flight to quality. Shippers are heavily favoring physical assets over pure brokers.
And this ties directly back to the regulatory purge and chameleon carriers.
Yeah, if I'm a logistics manager moving $1 million worth of laptops and I use a non-asset broker, I'm putting immense faith in a digital middleman who has no idea who is actually sitting in the driver's seat.
Exactly. Brokerage relies on anonymity and speed. They post the load to an anonymous load board, and some third-party carrier accepts it. If that carrier is a chameleon operating under a fraudulent DOT number, the risk to the product is astronomical.
So major shippers are throwing their hands up saying, we're done gambling. We want asset-based carriers like KnightSwift, where you physically own the truck, maintain the brakes, do hair follicle testing, and know exactly where our freight is. They'll swallow the double-digit rate increase for peace of mind.
It is a fundamental risk mitigation strategy. You vertically integrate your trust with the company that holds the title to the asset.
Okay, so we've established the macro environment. Tightening capacity, rate demands, panicked shippers. Let's look under the hood at how this impacts KnightSwift's massive corporate machine. They have 4 distinct segments: truckload, LTL, logistics, and intermodal.
Yes, and each is reacting uniquely.
Let's start with the juggernaut, truckload. The big headline here is that their revenue per loaded mile actually improved sequentially over the holiday peak season.
Which is a very rare feat. Normally, Q4 is the highest rate environment due to retail surges, and things naturally cool off in Q1. The fact that revenue per loaded mile went up from Q4 to Q1 speaks volumes about how rapidly the spot market tightened in January.
But inside this segment, there's a massive storyline regarding their recent acquisition of US Express, or USX. And I have to push back on their strategy here because I was genuinely confused. They spent a fortune acquiring USX to grow their fleet, but the call explicitly notes they actively shed a few thousand tractors from the USX fleet since buying them. Why buy a massive company just to intentionally shrink it?
It sounds incredibly counterintuitive. It's like buying a massive 50-room mansion and immediately bulldozing an entire wing of it.
Right.
But if we connect this to the overarching theme of quality over quantity, it makes brilliant strategic sense. Before the acquisition, USX was struggling with profitability, largely because 40% of their loads were sourced from third-party brokers on the spot market.
And we just established that broker freight pays lower rates and is highly volatile.
Exactly. You can't build a highly profitable premium network if half your business relies on scraping the bottom of digital load boards. You need direct contractual relationships. So Knight-Swift's first mandate was to purge the bad freight. They walked away from unprofitable routes.
But if you intentionally walk away from 40% of the freight, you don't need nearly as many trucks.
Precisely. And it wasn't just purging freight, it was purging bad drivers. Knight-Swift implemented vastly stricter safety standards at USX, weeding out drivers who didn't meet their rigorous profile.
And you can't argue with the results. They reduced USX's CSA crash basic score, the federal safety rating metric, by over 60%.
A monumental achievement in public safety.
Absolutely.
But the consequence is you end up with hundreds of unseated empty trucks. They chose to have tractors sit idle rather than dispatch them to haul unprofitable freight with potentially unsafe drivers. Running a truck at a financial loss is objectively worse than not running it at all.
So they sold off or returned off lease a few thousand excess tractors. And now USX is rapidly closing the operating ratio gap, trailing legacy brands by about 300 basis points, but catching up quickly.
A textbook turnaround story.
Now let's pivot to LTL, less than truckload. Just to establish the difference for the listener. Truckload is one customer renting the entire 53-foot trailer. LTL is for a customer shipping maybe 2 or 3 pallets. It's an incredibly complex, capital-intensive hub-and-spoke network of local pickups, terminals, and long-haul consolidation.
It's a fundamentally different operational beast. And while the truckload market suffered from overcapacity, LTL operates on a slightly different cycle, aided recently by the bankruptcy of a major LTL competitor, Yellow, which tightened capacity. Knight-Swift noted LTL revenue grew 2.6%, excluding fuel.
But the tonnage momentum was wild to see. In January, tonnage was up 1.6%. In February, it accelerated to 2.6%. By March, it was up a massive 6.9%. Why the sudden surge in physical weight?
Because they changed the type of freight they're pursuing. They saw a 5.2% increase in weight per shipment and an 8.5% increase in length of haul.
So they aren't prioritizing light consumer goods. They are winning heavy industrial customers, shipping dense manufactured parts or machinery.
Yes. And they are physically transitioning their LTL footprint from regional players to a true national footprint. Heavier shipments traveling longer distances generally yield much better operating margins because you maximize line haul weight capacity.
Got it. Okay, that brings us to the third segment, logistics. And looking at the numbers, this one is a bit of a shocker.
It definitely requires nuance to understand.
Because the top line numbers look atrocious. Logistics revenue dropped 9.9%, and volumes dropped almost 20%. But there's a wild stat attached to this. Knight-Swift intentionally cut the number of third-party carriers they tender loads to by a massive 30%.
Which perfectly explains the volume drop. You can't physically haul as much if you fire a third of your partner network.
But why would a logistics provider whose entire revenue is finding third-party trucks intentionally cut 30% of their carrier base?
If we connect this back to everything, the regulatory purge, chameleon carriers, unqualified drivers, it all converges here. Add to that one critical factor.
Yeah.
The unprecedented cargo theft epidemic.
Oh, right. Highly sophisticated organized crime rings stealing entire trailers of electronics or pharmaceuticals.
And they don't hijack trucks on the highway. They use digital identity theft. They act as fraudulent chameleon carriers, steal DOT numbers of legitimate companies, book loads digitally, load the freight legally at the dock, and then simply vanish.
Wow.
Knight-Swift decided they couldn't wait for the government crackdown. They aggressively vetted their internal third-party carrier network with incredibly rigorous standards.
They're essentially doing the FMCSA's job for them, verifying licenses, tracking VINs, demanding to know exactly who is in the driver's seat.
And when you apply standards that rigorous, 30% of your carrier base fails. So Knight-Swift ruthlessly cut them off, choosing to reject lows rather than risk their pristine reputation with shippers.
Right, because of that flight to quality. A single stolen trailer due to a negligent broker check could destroy a shipper relationship. So taking that volume hit is a calculated sacrifice to protect the brand. Okay, briefly touching on the final operational segment, intermodal, which is rail and truck transportation combined. Revenue was up 2.7%, and March load count was up 8.4%. They are slowly marching back toward profitability despite a highly competitive pricing environment against over-the-road trucks.
Seeing an 8.4% jump in volume demonstrates they are winning back market share even when the pricing delta between trains and trucks is tight.
And just to be thorough, their all-other segment had a new accounts receivable securitization program that cost $5 million to set up, weighing down operating income slightly. But the real story is in the trucks.
The overarching story is the structural macroeconomic turnaround, the painful transition from a vastly oversupplied market to a disciplined, highly regulated, asset-heavy environment.
So bringing this full circle, what does this all actually mean? We started with what optically looked like a disastrous 9-cent EPS quarter.
But as we've uncovered, the winter storm merely exposed the profound fragility of a market hollowed out by 3 years of unsustainable rates.
And now the government is stepping in with a massive regulatory purge, shutting down CDL mills, revoking invalid licenses, tracking chameleon carriers. This is rapidly draining the pool of cheap capacity, flipping leverage back to premier carriers.
Leading to shippers panicking, turning away from pure brokers, and capitulating to double-digit rate increases just to guarantee a safe truck shows up.
And Knight-Swift is sitting perfectly positioned, rescuing stranded freight, shrinking USX to only profitable freight, building a national LTL network, and firing 30% of logistics partners to protect their reputation.
Which brings the entire analysis back to you, the listener. Why should you care about any of this? You should care because absolutely everything you buy, groceries, electronics, the materials that built your home moves on these trucks.
Every single physical item in your life was on a truck at some point.
When cheap, unregulated capacity is forcefully purged, the aggregate cost of moving goods rises. What we are witnessing is the entire cost structure of physical goods shifting upward. The 10 or 12% rate increases Knight-Swift is negotiating today will absolutely be baked into the retail price of consumer goods tomorrow.
We are seeing the true, fully burdened price of safety and compliance. We've enjoyed artificially cheap freight subsidized by bad actors, and that era is ending.
We are all going to pay for that highway safety at the cash register.
But I want to leave you with one final provocative thought. We've spent this whole time talking about the complexities of human drivers. The regulatory purge is specifically targeting unsafe human drivers.
The human element is the ultimate variable of risk and noncompliance.
Exactly. But consider the long-term incentives. As these major trucking companies regain pricing power and their operating ratios return to the highly profitable mid-80s, they are going to generate massive free cash flow. And as the immense cost of training, testing, and managing human drivers grows,
the human driver needs to sleep 10 hours a day. A human driver can fail a drug test.
Right. How long until executives look at this newfound capital and pivot entirely toward the ultimate, perfectly compliant driver?
Autonomous AI trucks.
Exactly. An AI system never needs a hair follicle test. It doesn't fake its logbook. It doesn't abandon a load during a winter storm.
As the federal regulatory noose tightens around human fallibility, the economic incentive for full autonomy becomes irresistible.
So the next time you pass an 18-wheeler, don't just think about the rising cost of the freight. Ask yourself who or what will actually be sitting behind the wheel in the next economic upcycle.
It's an incredible paradigm shift.
The X-ray machine of the supply chain shows a fractured human system today, but the cure might be completely robotic tomorrow. Thank you so much for joining us on this deep dive into the beating heart of the economy. We'll catch you next time.